Welcome back, traders. Thanks for joining me here today. In this short video, you will get to know more about the long-term reversal patterns in technical analysis. You have learned about the continuation patterns in the last video. If you missed the video, you can review the video through the link in the description of this video. Long-term reversal patterns mean patterns in the market that change an existing trend into an opposite price direction. Long-term reversal patterns are effective at an extended top of a bullish trend or low of a bearish trend. Avoid trading the formation of long-term reversal patterns in a ranging or middle of a trend. Trading long-term reversal patterns in a ranging or middle of a trend usually lead to a failed trading setup. Here on this chart, what can you notice? We can see this rising wedge formed at the extended top of this bullish rally and not at the middle of the trend. Long-term continuation patterns are effective in the middle of a trend after price pullback. To confirm a long-term reversal pattern, we need to analyze the strength of the trend through the formations of short-term patterns and the momentum of the market. This is why the best way to implement the patterns trading techniques in the market is to blend both the short and long-term patterns together because they complement each other. We can see after the first higher high swing here, price made a bearish pullback. Price proceed further to retest the last swing higher high, but price failed to move above the level. Price made a U-turn downward. This action notified us of a possible resistance level for price here. After the failed breakout of the last swing higher high here, what can you notice as a technical trader? Number 1, we can see the reduction in the bullish momentum in this market through the reduction of the volume in the bullish candlesticks in this market here, when compared to the previous candlesticks in the strong bullish moves here. Number 2, also, we can figure the numbers of bearish candlesticks in this market were higher than the formations of bullish candlesticks when compared to the previous candlesticks in the strong bullish moves here. The bearish breakout and close of the candlestick below the rising wedge pattern gave the signal of a potential change of the trend, but not yet confirmed. The retest and rejection of price from the broken dynamic support trend line of the rising wedge through the upper shadow of this long bearish candlestick here confirmed the change of the trend and the long-term pattern. We can see trading the reversal of a trend is not as easy as when trading long-term continuation patterns. Patience and proper confirmation are needed to anticipate the reversal of a trend. Also, base your final decision on the daily time frame confirmation when planning to trade the reversal of a trend. Trying to trade the reversal of trend on the lower time frame usually leads to a false breakout most times. Early entry on the intraday charts is only suitable for long-term continuation patterns when it supports the direction of the higher time frame. To forecast the measurement objective, take profit target, of this rising wedge pattern, we need to measure the price move from the low of this bullish flag breakout zone here to the lowest higher high in this rising wedge pattern formation here. We can see it measures 504 pips. We can then replicate this 504 pips appreciation in value downward from the point of the rising wedge long-term breakout here. We can see it aligns to the support level of the bullish flag breakout zone here. This was why price resulted in a consolidation phase here before the resumption of the bearish trend. We can see how this long-term pattern led to the reversal of the previous bullish trend. Let's search for another example of the reversal of a bearish trend into a bullish trend through the long-term reversal patterns in the market. Here's an example of the reversal of a bearish trend into a bullish trend here. Price formed a symmetrical long-term pattern at the low of this bearish trend. We can see how price made a bullish breakout low volume. Let's analyze the bullish and bearish momentum in this symmetrical triangular pattern formation. We can see there was a continuous bullish candlestick here after the aggressive bearish move downward here. The bulls and the bears went into a tug of war here. This made price here move in a sideways market. The ranging market here signaled weakness in the bearish momentum to make a free flow of price downward. The bulls exerted more bullish pressure and the bulls made a bullish breakout here. Although the bullish breakout here wasn't a decisive breakout, price later closed below the dynamic resistance trendline of the symmetrical triangle. Price retested the second time, and the formation of a morning star short-term pattern confirmed the symmetrical triangle long-term pattern bullish breakout. We can see how the bearish trend was reversed into a bullish trend. To analyze the measurement objective of this long-term pattern breakout, we need to measure the distance from the high of the trend here, which led to the lowest low of this symmetrical triangle pattern here. We can see it was 865 pips price decline. We can now replicate this price move upward to forecast the potential future price movement of this long-term reversal pattern. The price movement upward aligns to this zone here. We can see when price got here, price rallied in a sideways market before the formation of a double bottom long-term continuation pattern, which resumed the bullish trend. Now we can see both the short and long-term patterns relies on each other to build a strong setup in the market. Patterns fail. Nothing is guaranteed in this game. When short and long-term patterns support the same direction of anticipation, such setups becomes more powerful and reliable than setups that have just a single pattern supporting its setups. In the next video, you will learn the difference between the bar charts and the candlesticks.